Hi, I'm Cassandra with Ardhi Real Estate. I'm here today with my preferred lender,
Dennis Work. I am a VP at Prosperity Home Mortgage. I've been in the business for 20 years.
and today we are here to talk about the mortgage reality and what's going on in this current market because there's a lot going on, right? So, Dennis, what's the biggest issue you're seeing in the mortgage world right now?
Right now, there's a lot of turbulency as far as rates are concerned, a lot of peaks and valleys, a lot of things that weren't really experienced in the past. So it's kind of like a new world, and we're all trying to understand and adjust to.
All right, so with rates still being elevated, what creative solutions are lenders and buyers making to make deals work in this current market?
There's many different things you can look at. If you're in the market and you're looking to buy, there's always going to be an opportunity to refinance down the line. If rates are elevated, which they are right now, it's better to buy your home, and then you're dealing with a situation where you're going to have equity at a time where property values are still increasing in certain areas. Within a year, 2 years, potentially you'll be able to refinance and then lower your mortgage payment.
So would you say in this current market, appraisals and lending standards are tightening, or would you say things are currently easing up?
I would not say easing up.
Okay.
I would definitely say there is some over underwriting, especially when it comes to hourly employees. We run into a lot of situations where we have an hourly employee that doesn't consistently work their 40 hours per week, or maybe there's 1 or 2 paychecks that show 32 hours, and then it bumps us into a variable income situation, which could kind of detour the deal from getting to the finish line. So underwriting at this current state, I would definitely say is not easing up at all. As far as appraisals are concerned, I have run into a few deals over the last couple months where we have come in under appraised value. One in particular was about $25,000 under that value.
Wow. Okay. So what happened then? You got to finish the story. You started
Well,
it.
at that point, it's a renegotiation with the seller. On this one, we were fortunate. There was a $10,000 seller assist.
Okay.
We were able to go ahead and meet halfway with that appraisal gap, still get the borrower their $10,000. And then the benefit with us, that home qualified for our $10,000 grant, which has since been suspended, but it did benefit for the borrower and made the transition and transaction go smoothly from there.
Okay. So is your mortgage company currently doing any type of down payment assistance program currently, since you said that previous one was suspended?
We have down payment assistance programs. We also do a lot of bond and agency programs. So any federally assisted grant is pretty much done with at this point. But as far as local agencies like New Jersey, Pennsylvania, Delaware, they're still going strong. Some lenders are putting a pause on those things. We are still dealing directly with the states and moving forward as business as usual.
So with the impact of the federal grants being suspended or canceled out at this point, has that been a big issue?
To be quite honest, it really hasn't had a major impact on business at all.
Nice.
Especially with New Jersey. New Jersey housing is pretty flexible with a lot of the things they do. You know, first generation home buyers, they get an extra $7,000 towards their down payment assistance. A lot of the things that I do directly are with the state of New Jersey, Pennsylvania, and Delaware. We are out in the community quite a bit. My division that I run in the Philadelphia metro area is our community lending division. So it is to promote first-time home buyers, but primarily we want to promote minority home ownership.
So Dennis, we've heard so much talk of housing market correcting or slowing down. What are the real indicators you're seeing from your side?
So 20 years in the business, this is a really hard market to navigate through. I lived through 2008 where we saw the huge decrease in property values and homes being underwater. At the beginning of this, as we're going through COVID and we're seeing homes rapidly increase in value, with rates being so low, there was a point where everybody thought things were going to correct themselves rather quickly. So as we got into 2021, the end of 21, going into 2022, it wasn't like a quantitative easing type of thing. Rates went from 3% to 5% pretty much overnight. And then eventually to 7%, where we're kind of been in that area for the last 2 years. So it's really hard to navigate what's going to happen. There's so many peaks and valleys in this market. When there's a good day, my suggestion is for my own clients and then my loan officer's clients, you got to get ahead of that. You need to lock them in and move forward with that loan when the market has that downward spiral.
So where exactly do you see interest rates heading this spring into summer? You're promoting, you think that buyers should lock in now and not wait?
I would always have a conversation with my borrower to lock in your interest rate because it's too unpredictable right now. You can't say, like it was in 2020 where the 10-year was hovering right around 1, even less, and rates were consistently for a year and a half at 2.5% to 3.5%, which is an unrealistic market, period. At this point in time, you have a contract, you're closing in 30 to 45 days, lock your interest rate in.
Okay. Well, so what are some real strategies buyers can use to save money to purchase at a higher rate market, or to make sure that they're able to get into the house of their dreams because there's so much going on in the economy?
There's certain programs that you can definitely look at, 2-1 Buydown being one of them, where for the first year you're 2% lower than what the actual note rate is. Year 2, you're 1% lower. Year 3, you want to make sure that it's still affordable to the borrower and they're comfortable with that payment. You are qualifying them off of the higher interest rate, but you want to make sure that they're comfortable with that payment in the event that rates do not go down. Historically, with the trends in the market, rates will drop, but I don't think we're ever going to see the 3s again. I don't think that was healthy for the housing market. It was to extend it, but if we get to a place where we see the low 5s, maybe the high 4s, that would really make a huge impact on moving more houses and motivating sellers that are in the 2.5% to 3.5% rates to then put houses on the market and move again.
Speaking of buyer saving strategies, can you break down the concepts of temporary buy downs? Who should be using it and why?
Absolutely. So you're going to have buyers that are on the fence with this current market, which is really understandable. But if you have those higher end buyers that are in that $600,000, $700,000, $800,000 market, it is a good product to offer. They're going to be more educated. They're not a first-time home buyer for the most part. They're going to understand how the product really works. So just as an example, you start at your note rate is 7%. For that first year, you're going to be locked in at a payment at 5%. You want to talk to them about how your payment is going to increase again. You're going to be 2% higher. So what you really want to have them understand is if for some reason the market doesn't correct itself and we don't see a rate reduction over those 2 years, this is what your payment's going to be at the start of year number 3 of the temporary buy down. So have them understand that, tell them what year 1 payment is, year 2 payment is, and then this is year 3. This is your real payment for the life of the loan after that.
So Dennis, why would someone do that? Why would somebody do a rate buy down versus getting a traditional loan or just a regular loan?
For the affordability factor, you want to have that conversation. A lot of individuals that you speak to in that particular market think they know what's going to happen within the rate world. Honestly, none of us know, but having that conversation, and a lot of people are really dead set on a certain payment. So if you can have a conversation and say, hey, look, I can get you that payment and I can guarantee it for year number 1. Year number 2, your payment is going to go up a little bit because your rate's increasing 1%. But over the course of that buy down, who knows what's going to happen to the market? You could be in a situation where rates do drop to where your current start rate was in that buy down, where you were very comfortable with that payment and you can refinance, and now that's your payment through the life of the loan. With the buy down, you're playing the market. You're hedging your bet.
Okay, so if you're in year 2 and you're at 6% now, but the market interest rate has gone down to 4, would you now be eligible for the 4, or are you still at the 6 year 2? You
can definitely go ahead and refinance out of the buy down at that point, and that's the whole purpose of doing this particular product. It is for the individual that wants to make sure they're in affordable payment for the first year, but from the due diligence standpoint of the mortgage company, we want to make sure you can afford that payment. If your start rate was 5, we want to make sure you can afford 7. And that's a conversation I have with everybody. If you're stretched ratio-wise above what the standard guidelines are, I had that conversation with you, and I'll tell you, hey, for the first year, this is your payment, but in the event rates don't drop, then you're going to be at this payment for year number 2, and then year 3 through 30, this is where you're going to be. Make them fully aware of what the product is. If they're willing to hedge their bet, it is a great product to save money initially, and chances are rates are going to adjust and come down in that time period.
Now, does it require the buyer to have more money up front when purchasing the property, more down payment or closing costs?
No, I mean, it's a standard conventional loan.
Okay.
As far as costs are concerned, there is a little bit more, it is a buydown, so there is some cost associated with getting that rate for the first year, but it does offset itself, and when I sell a 2-1 buydown, I will break down the cost associated with what they're saving in payment and let them know if they're going to make that payment up, the difference in payment opposed to the cost over that time frame.
Well, Dennis, thank you so much for that information.
Thank you for having me, Cassandra. It was a pleasure, and I look forward to the next one.
So that wraps up this session, but I want you guys to know that we are going to continue these chats because we want to continue giving you guys information about the mortgage and real estate world. If you guys have any questions, please feel free to reach out to myself or Dennis. The information is below, and we would love to answer any questions that you guys have. Until next time.
Thank you.
Peace.